All right, what's up, guys? I hope you're doing well. James here from jamesdforsythe.com. Really wanted to go over a paper I found and I found it when I went to Rebel Capitalist Live in Houston back in January. It was a paper by Dr. Richard Warner, or I guess Werner. Um, and basically, the reason I want to go over it is because it really kind of destroys the idea that, we need low interest rates for high growth in terms of an economic environment. And really shows quite the opposite. And so he used something called the Granger test. And for full disclosure, I'm not an economist, obviously. But I do enjoy reading these kind of articles, and especially with the stuff that's posted by, or I guess it's part of things like Science Direct and Elsevier and stuff. I used a lot in college for my physics degree. Um, but in terms of economics in general, that's not what I did specifically. It's more of just a post-secondary interest. But anyways, he showed quite the opposite, essentially that high economic growth causes high interest rates. And he did this through um, basically proving the correlation between the two and also causation using statistical methods. And the actual math behind that and such isn't necessarily the point of this video. It's more just to kind of um, put it out there because it is contrary to what you normally think, as I said in the title, what the mass is and such. So, regardless, we're going to head straight over to the screen share and we'll get over to there. Window, that one. Let me make sure that you guys make it bigger. Okay. So, so basically, in the abstract, examining the relationship between 3-month and 10-year benchmark rates and nominal GDP growth over half a century. In 4 of the 5 largest economies, we find that interest rates follow GDP growth and are consistently positively correlated with growth, meaning they move in the same direction, right? So as economic growth increases, so do interest rates. And that, and once more, the interest rates lag behind growth. And so as growth increases, then the interest rates will increase, and then vice versa when they come down, right? And so we conclude that conventional monetary policy as operated by central banks for the past half century is fundamentally flawed. And keep in mind, this is from the man who essentially invented quantitative easing. I'm pretty sure he's the one who actually coined the term when he was an advisor for the Bank of Japan. And I want to say the 90s, but I'm honestly not 100% sure. Um, at least the time frame. But okay, so yeah, basically, the present paper for the first time systematically examines the empirical relationship between the level of nominal interest rates and economic growth, right? Okay, so just kind of putting a whole bullet into that idea. Okay. Um, and so kind of in the intro, he's talking about a bit of the assumptions and how you think of the economy in general, right? So he talks a lot about how I want to make sure that I don't miss anything. So pretty much with equilibrium, right? And so he says in an equilibrium setting, prices are key. Their movement is said to achieve the postulated equilibrium. Any problem, such as persistent large-scale unemployment, is interpreted as being due to price rigidity that must be remedied, right? And so it's not necessarily the price of money per se, but it's more once you get too far out of equilibrium, at least what I got from this, it's more of the supply and demand equation that really dictates what's going on rather than the price of money. At least directly is what it seems to come from this, right? And so, however, and basically these equilibrium models and stuff that he's talking about, he said there's kind of a basis of 8 assumptions that really kind of make the whole thing up. And if even one of those doesn't um, isn't correct or doesn't pan out per se for like the actual real world application, then the whole model is basically, I don't want to say null, but it significantly decreases how applicable it is. And so those assumptions include perfect and symmetric information, complete markets, perfect competition, zero transaction costs, no time constraints, fully flexible and instantaneously adjusting prices, right? So equilibrium will not obtain if only equilibrium will not obtain if only one of the axioms and assumptions fails to hold, but their accuracy is not tested. Yet one can estimate the probability by obtaining equilibrium. It kind of continues to go on with actual probabilities. And so, since for partial equilibrium in any market, at least one of the above eight conditions have to be met. If one generously assumes each condition is more likely to hold than not, corresponding to a probability higher than 50, and so he uses 55% just as an example, then the probability of equilibrium equals the joint probability of all the conditions. That's I guess basic probabilities when you're actually adding them up for multiple cases. And so that's 0.55 to the power of 8, which is less than 1%. Basically saying that you have a less than 1% chance for all 8 of these instantaneously held, right, to be true. Okay. Therefore, equilibrium is a theoretical construct unlikely to be observed in practice. This demonstrates that reality is instead characterized by rationed markets. These are not determined by prices but quantities. In disequilibrium, the short side principle applies. Whichever quantity of supply and demand is smaller can be transacted, and the short side has the power to pick and choose whom to trade. And so essentially, it's not so much the prices that dictate the market itself, it's the actual supply and demand of the, I don't want to say products, but the objects or what goods or services that you're dealing with, right? Or commodities, whatever. 'Cause that's really his point. And so it's since you're not really dealing with equilibrium, it's not so much that the price dictates the supply and demand, it's vice versa, and then it kind of follows, it seems to be. And so, or maybe not 100%, because obviously you have to deal with the whole, or at least the idea that high prices cure high, or high prices cure high prices because more supply will come online, and so there's kind of obviously a market perspective to that, but it's more of the quantities themselves are more important than prices in terms of this, right? Is his point. Okay, and a few other things just to kind of throw them out there that he puts in here. So another one of his papers in '94 found that in a model of capital flows, price variables, interest rates, and interest differentials had little explanatory power, while quantity variables, the quantity of credit creation, from two other papers he cites, found little support for so-called liquidity effect on this stuff. Also, other papers found a positive correlation between real GDP growth and interest rates in the U.S. between 1950 and 2000, so he's not the only one, and talks about Japan and other stuff. But we'll just continue down to actual graphs and such, right? And so again, down here, instead, we found that interest rates follow nominal GDP growth and are positively correlated, meaning again that when one goes up, the other goes up. And kind of trying to unpack these graphs specifically. So the black lines are, see if I can zoom in a little bit. So maybe it's easier to see. And so, because I know maybe there. Yeah, so I know the difference between black and blue when the lines are so thin is pretty difficult to see. So you have the blue line here for Germany and then the black line as well. I think black is the nominal GDP year over year, and then it looks like the blue is the 10-year government bond rate. And so you can see in general, they kind of correlate to where they have the same general form. When one goes up, the other does as well. And you can see where blue, which is the bond rate, it seems like it almost precedes it to a certain degree. It's kind of difficult to see what these specifically. So I'm going to zoom back out and go more in depth when we actually get to the, I think it's the Granger test, where you actually test the correlation between the two. And so you have here, So in data, to keep in mind, they did do this kind of their, I guess, their data set or their basis or whatever. It was 52 years, looks like from Q1 1957 to Q4 2008. And that was for, they did the UK, the United States, Japan, and then Germany and Germany. So they did those four. So all kind of, what's the word we use? I don't know, first-rate economies or whatever you want to call them. The specific term just kind of flew away for some reason. Anyways, but again, the same is observed in all other countries. Interest rates appear not to lead, but to follow economic growth. And so they basically just going into how they use the time series and more of the nerdy stuff, right? You have some tables with some of the correlation constants, which you can see obviously changes depending on how they kind of spread the times. So in terms of the nominal GDP growth and then the actual bond rate, and so there's a difference in correlation there. Okay, we'll go straight down. These are the graphs I was talking about, right? And so one is showing correlation itself, and then you kind of so one positive correlation are like I guess 100% correlation, and then negative one would be 100% negative correlation, right? And so positive being again they follow each other or they go in the same direction, I should say, and the negative is they're completely inverse. I guess inversely correlated. Um, but anyways, and you can see what really changes, and this is what I mean by it's hard to kind of tell by just these graphs alone, because it's not really measuring the correlation itself. It's like you see with the UK during this time series was almost won the entire time, showing an extremely well positively correlated uh, factors, I guess. And then you can see definitely where, like in Japan, how that kind of breaks down for a while, and for a period it seems like they had no correlation whatsoever. So there's that. And then kind of the same idea just for this one's for 3-month interest rates. So you have a difference between short term, which obviously the short term you can tell even with Japan when the okay. So the difference between these two is this is the 10-year bond rate, so more of longer term interest rates. And you can see that especially here in Japan there's more of a breakdown to where that correlation isn't as much of a factor. And then with the other ones you still kind of see it. And then, or on the other hand, I should say, for the 3 months, so more short-term rates, the correlation is much more positive over everything, right? It's even for Japan in the 90s and early 2000s, it seems. Okay, and so yeah, pretty much it for the actual conclusion parts. You have reality as the opposite in 2 dimensions. Correlation and causation. Those are the 2 dimensions he's talking about. Again, this is kind of just reiterating everything that we've been saying. It's really the concept that kind of matters. So higher growth causes higher interest rates is what this paper found, right? So for conclusions, some of their findings are kind of a summary of it. Nominal GDP is highly and positively correlated with short and long-term rates in all four of these countries. And then nominal GDP growth, Granger causes long-term rates in all countries examined, whereas the opposite holds only in one country, which is Germany. And then 3, nominal GDP growth, Granger causes short-term rates in all four countries, whereas the opposite holds only in one country, and that's the U.S., right? And so I misspoke earlier. The Granger test is for is testing the causation, it seems, and so literally being like this causes short-term rates, or I'm sorry, so saying that the interest rates cause GDP growth. I did it again. Okay, I was right the first time. That the long-term rates and short-term to us even seems even a more so extent, right? They cause higher interest rates. So you need growth for the interest rates to increase, right? That's kind of the whole point. Um, but anyways, I'm going to come up here and stop at the title so you guys can actually look it up if you want. And yeah, I highly recommend you actually read the paper. Um, so Yeah. Anyways, that's all I got for this one. And so it's really trying to this is definitely a new kind of area for me. Getting more into the technical stuff for um economics in general. Like the Granger test and stuff is rather new, and so I haven't looked too much in depth with it, but still, it's more of the concept that the paper proposes and the findings that are kind of important, I think. So it's a different way of thinking about things with the whole like higher GDP growth causes higher interest rates. And I'd assume the argument is like since you have the higher GDP growth, more entities are able to afford higher interest rates. And so you kind of have a that's what's really causing it. And so um and I guess for lower GDP growth, meaning that, it's harder for most businesses and other institutions to actually, I guess, profit. And then so they can only afford lower interest rates. Not so much it's really kind of changing it's looking at the system from a GDP kind of centric point of view rather than interest rates, and saying that the price of money, aka interest rates, is kind of secondary to that. And so the emphasis is more on the actual supply and demand of the goods and services rather than the price of the money that you use for those. At least that seems to be my takeaway. I don't know. I'm definitely gonna have to read some of the other citations that he gave to really get more points of view on it. But I kind of just wanted to share it, and so that you guys can look at it as well. Since it's so different from, I guess, general consensus, I thought it was worth throwing out there and kind of thinking about it on a more open forum, I guess I should say. But anyways, I'm gonna leave it there. So I hope you guys have a